Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. The hidden costs of empty units: why high vacancy destroys profit. Many new investors focus heavily on potential rental income, forgetting what happens when the unit sits empty. An investment property that remains vacant for months doesn't pause its financial obligations. It becomes a liability, eating away at your cash reserves month after month. The financial consequences of high vacancy are simple and brutal. They destroy profit through fixed, non-negotiable costs, property taxes, and never-ending WA fees. The most dangerous aspect of a vacant unit is that expensive, fixed costs continue to pile up. Property taxes are due regardless of whether a tenant lives there or not. Likewise, homeowners association (WA) fees do not stop just because the condo is empty. These fixed costs quickly turn monthly savings into significant liabilities. For example, a downtown condo might have $500 in WA fees and $400 in property tax equivalents each month. If your unit is vacant for 6 months while you search for a suitable tenant, you forfeit all potential income and must pay $5,400 out of pocket. This money cuts deeply into any profit earned later in the year, sometimes erasing the entire annual return. The danger of price drops and fierce competition. When an area experiences prolonged high vacancy, it signals a deeper problem. The local housing supply has eclipsed demand. Too many brand new units are chasing too few available renters or buyers. This market surplus forces desperate property owners to compete fiercely. If your neighbor drops their monthly rent by $200 just to fill a unit, you usually must do the same to compete. This competitive downward pressure severely limits potential rental returns even after you find a tenant. Even worse, if you decide to sell a condo in such a market, you often receive less than expected because buyers know they have many similar options available. You lose the appreciation potential that makes condo investing worthwhile. Spotting the red flags. Markets to avoid in. To invest safely, you must look beyond the glossy marketing brochures. Certain characteristics and market conditions place specific downtown condo markets into the high-risk category. These are the areas where high vacancy is most likely to persist. Areas still relying only on office commuters. During the pandemic, many office workers shifted to permanent or hybrid remote schedules. Downtown districts that haven't adapted to this work-from-home trend are the riskiest investment spots. Think of districts designed primarily around a central cluster of corporate towers. If the primary appeal of that location was a quick 5-minute walk to the office, and that office tower is now operating at half capacity, the primary buyer pool for high-priced condos has vanished. Residential demand suffers immensely when the core job market disappears. Look for this red flag. Downtown areas where restaurants, dry cleaners, and coffee shops are closing early on weekdays, suggesting low foot traffic and a lack of daily worker presence. Wise investors must find areas with a diverse employment base. If the area's entire economic identity relies on high-density office use, its condo market will suffer until, or unless, those offices fully reopen. Locations dominated by luxury studio condos. Many city centers experienced a massive building boom in the last decade, often focused on small, expensive studio or one-bedroom units. Developers built these units mainly for single, high-earning professionals who prioritized location over space. The current trend shows that many renters, especially those who can work remotely even part-time, are seeking more living space outside the immediate core. They prefer a slightly longer commute if it means a larger apartment or even a small house. This sudden shift has created a significant oversupply of luxury, smaller unit types in some downtown markets. These specific units become the first to experience high vacancy because their target demographic is the first to leave the city center for lower-cost, roomier options. Look closely at the unit mix in any new condo development before investing. If the majority are compact studios, proceed with extreme caution. Vacancy can turn a promising property into a costly mistake. Stay tuned for Part 2. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.